Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and lately a lot of you have been asking me what are the best data center REITs to buy today. The AI revolution is a very strong long-term tailwind for this sector, and therefore it's understandable that a lot of you are now interested in investing in this space. However, the problem is that this is well known to the market. Everybody knows that data center REITs will benefit from the AI revolution, and therefore this is now largely priced into their stocks already. I'll put a table on the screen showing you the valuations of Equinix, Digital Realty, and Iron Mountain, which are the three biggest data center REITs in the US. You will see there that their AFFO multiples, which is a measure of cash flow in the REIT sector, are already quite high at 20 to 30 times. And you should note here that these REITs have historically been quite aggressive in how they calculate their AFFO, often hiding some of their maintenance capex by disguising it as expansion capex. And I think that if you properly accounted for this, the FFO multiples will be even higher at closer to 30 times. Some REITs are of course more conservative than others, but there's really skepticism about all of them, about Iron Mountain, Digital Realty, and Equinix, and it's really hard from the outside to really know what should be considered as expansion capex versus maintenance capex. Then another thing that worries me is that while the demand for data centers is clearly growing, so is the supply. Everyone now knows about this opportunity and it has attracted very significant developer interest. Increasingly, even the tenants themselves, like Microsoft, Google, and so on, are building their own data centers. And so while I think that demand should remain strong for quite some time, there is high risk of eventual oversupply hitting this market. Finally, I also worry about long-term obsolescence as technology continues to evolve and potentially eventually renders today's data centers obsolete. Today already the cooling requirements, server density, and power usage are very different from the data centers of just a decade ago. This then forces landlords to keep heavily reinvesting in their properties to keep them competitive. For all these reasons, the risk-reward of owning data center REITs has historically not been that compelling in my opinion. You pay a high valuation to capitalize on a clear trend. However, there are a lot of question marks about future capex needs as well as the coming supply hitting the market. For all these reasons, I don't think that the best data center plays are those American data center REITs like Equinix, Digital Realty, or Iron Mountain. Those picks are very obvious to the market, they've already been bid up to higher levels, and therefore they're not my choices. Rather, I'm investing in a British industrial REIT with a rapidly growing data center platform that's still today heavily discounted, as well as an alternative asset manager that's preparing to launch a data center REIT. But before I dive into these companies in more detail, I want to remind you that we are currently sharing all our top picks for 2026 at High Yield Landlord. And if you want to access this series as well as my full portfolio for free, you can join us today for a 2-week free trial, and you'll also get a special discount as part of our Black Friday sale. Okay, so the first company I want to discuss is SGRO PLC, ticker symbol SGRO. This is a British industrial REIT. It's one of the biggest in Europe. It owns a very attractive portfolio of urban Class A properties that are modern, new built, and enjoy high barrier to entry locations. This REIT, just like most of its peers in Europe, as well as in the US, experienced a boom in demand following the pandemic, as it led to a rapid acceleration in the e-commerce business. But then this was met with a lot of new development activity, which then led to oversupply in 2023, 2024, and even 2025. This combined with the surge in interest rates depressed its market sentiment and its valuation to some of the lowest levels in nearly a decade. But the good news is that conditions are now finally improving. Occupancy has stabilized, so has rent growth and its NAV per share. And beyond that, the reason why I'm discussing this particular REIT in today's video is that it has a rapidly growing data center platform and is now doubling down on this business. Just recently they announced a new major JV with a data center developer. SGRO is going to contribute a lot of its land into this JV, and in return it's going to end up owning an interest in a large data center portfolio. They expect near double-digit initial yields on these new development projects, which will far exceed their cost of capital, resulting in significant accretion to their FFO and their NAV per share. And my prediction is that as SGRO now continues to expand its data center business, eventually this is going to greatly benefit its market sentiment. Just look at how the market warmed up to Iron Mountain, which is a paper storage REIT, as it began to move into the data center space. The narrative went from being a paper storage REIT with poor long-term growth prospects to being a very compelling data center play, and as a result its multiple expanded very significantly, resulting in a huge upside for investors. SGRO is now replicating the same model, but its legacy industrial portfolio is far more attractive than the paper storage assets of Iron Mountain in my opinion, and yet it's right now trading at a much lower valuation. In both cases, the data center business is still relatively small, representing just about 10% of their total businesses. But both are very well positioned to grow this data center business as they own a lot of undeveloped land. They have the relationships already with tenants like Amazon, Meta, and so on, and they have the skill to develop these properties. The key difference is that SIGRO's industrial portfolio enjoys far better long-term prospects in my opinion, and therefore I think that it should be priced at a premium to Iron Mountain. But since this is not the case today, I think that SIGRO is a very attractive, underappreciated play on data centers. The market still sees it today as an industrial REIT that's struggling to grow due to the current oversupply, but I expect this to change drastically now as the oversupply turns into undersupply, rent growth accelerates for its legacy industrial portfolio, and at the same time it keeps rapidly expanding its data center business, and eventually the market starts perceiving it as a play on data centers. As the narrative changes and the REIT reaches a better market sentiment, just like Iron Mountain already has, we expect 30 to 50% upside, and while we wait, we're earning a 4.5% dividend yield, and we also expect the REIT to grow its FFO per share at a mid to high single digit over the long term. Therefore, just combining the yield and the growth, we expect to earn about double-digit total returns, and on top of that, we enjoy significant repricing upside potential as the market sentiment improves, and therefore we really like the risk to reward of SIGRO PLC. Hey, before I go into the second company, can you please do me a huge favor and click the like button if you enjoy this type of content? Thanks so much in advance. The second company in which I'm investing in order to profit from data centers is Blue Owl Capital, ticker symbol OWL. It's one of the leading alternative asset managers, just like Blackstone, Brookfield, KKR, and so on. Historically, it has mostly focused on private credit, net lease, and GP investments, and what's unique about its model is that most of its capital is permanent, meaning that there is no redemption right for investors, and it results in much more consistent and predictable cash flow. Moreover, most of its fees is derived from management fees rather than incentive fees, which is also a lot more predictable. Therefore, we've previously argued that Blue Owl earns REIT-like cash flow that's highly consistent, all while being able to grow at the faster pace of an alternative asset manager, given that it's running a capital-light business. And right now, the REIT is very rapidly expanding into data centers. It's already one of the leading players, managing about 14 billion worth of data center investments, which represents about 5% of the current total lease capacity globally. But importantly, Blue Owl has just recently signed deals worth over $50 billion to build data centers for OpenAI, for Meta, and for Oracle. It's been picked as the partner of choice for the 3 biggest data center financings of this year. And that's really just the beginning. The management discussed on their recent earnings call that they have about $100 billion worth of data center deals in their pipeline. They also signed a new deal with the Qatar Investment Authority, which is the sovereign wealth fund of Qatar, to start a new data center REIT. They are expected to provide initial funding of $3 billion to it, and they will then scale it from there by including many other investors. Therefore, Blue Owl is going to be a big winner of the AI revolution, as it's set to rapidly scale its assets under management in its data center business, resulting in significant fee income for Blue Owl shareholders. What I like specifically about Blue Owl versus being a landlord like a data center REIT is that we are just the asset manager here. We're earning management fees for providing these services to these permanent capital vehicles, and I really like the risk to reward here of being an asset manager, as we don't actually own these data center assets. Instead, we are managing permanent capital vehicles which are resulting in highly predictable and consistent cash flow from fee income, and so we are not so dependent on the future investment returns of these data centers, which are somewhat questionable, as I discussed in the intro of this video. And in that sense, I think that our positioning is a bit safer than that of a traditional equity landlord. Blue Owl has guided to grow its assets under management as well as its cash flow per share by over 20% annually over the next 5 years. And despite that, it's today trading at a very low valuation, offering a 6.5% dividend yield, and so if you combine that growth and that yield, you have a very attractive story in my opinion. The reason why it's priced so cheaply right now is because most alternative asset managers have sold off recently due to a weakening economy, which has sparked fears about private credit, but also other type of asset classes. And I think that the market is yet to recognize that Blue Owl is positioning itself to become a leader in the data center space, and so it's not yet perceived to be one of the winners of the AI revolution, and so it's not priced accordingly just yet. I think that as they keep signing these big deals with companies like OpenAI, Meta, and so on, eventually this will impact their market sentiment and their valuation will get beat up to a much higher level. Right now, we still have the chance to accumulate shares at what we think is a very compelling valuation and earn a high yield while we patiently wait for long-term upside. The management has added a slide on their investor deck that lays out the math on how they think that between the yield, the growth, and the earnings multiple expansion, they could more than triple or even quadruple investors' money over the next 5 years. That might be a bit aggressive, but even if we get just halfway to that, the reward should be very attractive in my opinion. For all these reasons, we view Blue Owl as one of the best ways to invest in data centers at high-yield landlord. If you want to access our full portfolio, you can join us for a 2-week free trial. It will be the first link in the description of this video. Once more, if you enjoyed this content, consider clicking the like button. Helps me a lot to keep on growing. Thanks so much and see you at my next one. Bye bye.